So we're going to do now a example of the weighted average cost of capital that's in your textbook. Again, let me just remind people what we're doing is when you have to find a cost of capital, we find out what kind of long-term capital the company borrows, find the cost of each one of them, and then take a weighted average. For example, in this case, assume you have to spend $50 million to renovate the company's warehouse distribution systems. It is expected to generate after-tax cash flows of $12 million for 6 years. The debt-to-equity ratio is 1:3. Cost of debt is 10, cost of equity is 20, tax rate is 34, should they invest in the renovation. So in this case, the information is already given to you. The only thing here, the catch here, is to find out what percentage of it is debt and what percentage of it is an equity. So debt to equity is 1/3. Or in other words, debt is equal to 1/3 equity. Now you can do it in various ways. If you want easily, you say, all right, you just take some number for equity because debt is 1/3. Make it so that it's a round number. So if you, let's say, have 150, then 1/3 of 150 is 50. So you can say this is debt and this is equity. Same thing can be done with 25, 75, debt and equity. So the total here is 100. So remember, we want the debt percentage as total assets, so that's 25%. And equity over assets is 75%. So in other words, this company borrows as such. 75% is stock, equity is 75%, and debt is 25%. So now it's a straightforward way to do it. We say the weighted average cost of capital, remember, is equal to the weight of the debt and the stock. So stock is 75%. And we need the cost of equity. Then 25%, we need the cost of debt. But don't forget, with debt, we have to take the taxes away. So let's see. Cost of equity is 20%. Debt is 10%. Tax rate is 34%. So equal to 0.75, 20%. We can actually put the full number. We don't have to put a point. Plus 0.25 is 10%, 1 minus the tax rate. So that equals, and we might as well just go straight here, it's equal to 16.65. 0.65%. So we should use 16.65 for our discount rate for any project, because that means if you earn 16.65, you'll be able to pay off your debt as well as satisfy your stockholders who are apparently demanding 20% from your firm. So now let's see. It's going to cost $50 million and the outlay, and $12 million for 6 years. So what it means is you'll dish out $50 million here, and for the next 1 year, 3, 4, 5, 6, you'll be getting $12 million after-tax cash flows. So we don't have to calculate as much. So the only thing you need to know now is to find the net present value at 16.65%. So by now you know how to do this, but this is C0, this is C1 6 times, compute the interest rate is 16.65, and it turns out to be negative 6.53 million. 53 million. That means we will reject the project. Now, at what rate will it be acceptable? So we need to find out at what rate net present value will be equal to at least 0, So that's, I'm just adding to this question that obviously the answer is you need to find out the IRR. So I'm just going to do that quickly. Second clear work, 50, change sign, enter down arrow key, 12, enter down arrow key 6 times. Let me just calculate the NPV with 16.65. And it's correct, it's negative 6.53. So now I press IRR compute, and it comes 11.5305. So if I could discount this at 11.5305, I'll accept the project because that's what the IRR is at this point. Okay, so that's how we use the IRR. All right, let's moving on. Now, one of the first thing that you have to be careful is that the WACC is to be used only a project of similar risk. So for example, let's say I find out that the way the debt banks are giving me, or bondholders are investing in my bonds at 10%, stockholders at 20%. And that's because they have evaluated my firm, and that's how I do a weighted average cost of capital, and I come at 16.65%. But let's say you did borrow, and you did borrow 10 or let's say even $100 million from them. We have to be careful that you don't use this into projects of really high risk. For example, suddenly you change your mind and you say, I want to do an Australian mine, because I heard that product is really going to go up at that point. Well, technically you're not allowed to because the market didn't know about that. If the market had known you were going to use this money for a mining company in Australia, they would have probably demanded 25%. So the one thing we have to remember is weighted average cost should be used with firms of the same average risk. So if they were going to invest the money of these creditors and investors, they cannot steer away. But in reality, what happens is many firms borrow, let's say, a whole bunch, 100 million, and then they put 10 million here, 5 million here. So overall, at least it should hit the average risk at that point. But then we become into a problem because how do you, if you say you have to use on average and get 16.65%, how do we decide? Because, you know, projects can vary and can be varied of different risks. So let's take an example here. Let's assume the risk-free rate is 5%. And then we have a company or a project. We can even think of it as a project. This take the example could be the beta 1 point of weighted average cost of capital 15%. Now, suppose we take a project that is a beta of greater than 1.25 with an expected rate of 16. What happens then? So the best thing is to look at this, right? Let's say we have 1.25 is the average risk of this company. And based on that, we managed to get a weighted average cost of capital of 15. So now what happens is, so we want to invest some of that 100 million, and let's say we want to invest it in a company that has a beta of 1.25, whose weighted, I'm sorry, of 1.25, but whose expected return is 16. Sorry, has a beta greater than 1.25. So now what happens? So you have a, let's say it's a 1.5 beta, and it is giving us a 16% rate of return here, right? So what will happen is that we might accept the project, but the problem is the project might be, so let me just do this example. Right there, where it's 16%. So, wait 1 second. Sorry, I made the mistake and I had to redo that. Assume you had a riskier project, let's even dramatize it, at 2%. and the return is 16%. Now, if you say my weighted average cost of capital is 15, and then there's a project A, let's say a project A that's giving me 16%, you cannot automatically accept that because it could have a beta of 2. And technically, a project of beta of 2, let's say, should be giving 20% at that point. So that's what happens. We call this the area of incorrect acceptances at this point. So in other words, you may accept it when you shouldn't be accepting that place. The same could happen, let me see if I have a diagram for that, over here. Let's say you have a very reasonably safe project. Let's say it's 0.5. And it gives a return of 14% right there. Well, we're going to say, wait, no, my weighted average cost of capital is 15. I cannot accept projects under 15. But what we're saying is, look, but this has very little risk here. So you're better off with this project. It can temper out your other projects. So what happens is we'll reject these projects below 15%. So what we're trying to tell you is that, look, when you have a weighted average cost of capital, if it's the same risk, then it is okay. But if it's different risk, then you have to make some calls on how to accept it. So you can use the security market line. That is one way of doing it. And the other way is you can do what we call the pure play firms. So what you can say is, look, I know this industry. So in the pure play way, what we do is we seek out firms with the same risk of the divisions of projects. So for example, if a grain company is planning to enter the retail business, it needs to find comparable retail and assess the cost of equity in that. So it's a little tricky. We won't do this problem in class. So going back to our example, let's say we are a grain company. Our weighted average cost of capital is 15 because our beta is 1.25. But now you want to go into another business, let's say in the grain retailing business, into the retail business. Then what we have to do is we have to look at another retail industry. And there, if we find out that, listen, the weighted average, the expected return on these is about 17%, it's a higher risk, 1.5. But if you think you can have a 1.5 weight up and make 17, then you should accept it. It shouldn't be that you should reject it because of, accept it just because it's 17, but you should know its risk and accept that at this point. So for 1.5, is 17 is appropriate. In other words, at 1.5, it is right there or above, then you say, good, then it's worth it, but for my 100 million, I'll buy something else that's less risky so that I get an even return at 16.5 or more. Actually, you could invest in a mostly risky project as long as the return is reasonably high at that point, okay? An alternative way is a subjective approach. And that's what actually most firms end up doing. Let's say the weighted average cost of capital for you is 15%. Well, what you could say is if I have riskier project, then I would demand 7% more. So I'll only accept project with IRRs greater than 22%. For less risky projects, then I'll just come 4% down. I'll accept projects whose internal rate of return or any rate of return is 11% or greater. But of course, this is very subjective. So it's very important to know that when you have a weighted average cost of capital, it's meant for project of similar risk. You can take on additional risk or less risk, but make sure you're earning the right amount based on some criteria. It could be you use the security market line, you could use pure play firms, or you could use subjective valuations. The final topic in this is flotation costs, because and it's just another twist to the mechanics of it, but nothing major at all. In most of these companies that end up borrowing, either through bonds or stocks, it's not cheap. They have to pay a certain amount to the investment bankers like Morgan Stanley, Salomon Brothers, Merrill Lynch, etc. There's a huge cost associated with raising debt and issuing securities. So, for example, in terms of issuing stocks, getting 7% is not unusual, and debt, of course, is much lower. And now, with online fundraising, etc., the costs have come down, but still, if you want to go for high-powered companies, they're not going to back down on their prices. So how do we incorporate these prices? We call them flotation costs because this is what it takes to float an issue, either a bond issue, float a bond issue, or float a stock issue. So from that word came float a stock issue. So from that word came flotation costs. Well, there are two ways to do that. So assuming you have your net present value all done analysis, one thing we could say is, listen, my weighted cost of capital is 16.65. Well, it costs me another 0.35 to this pay as commissions or as broker fees for arranging all this placement of our securities. So let's just increase it to 17% and say we demand a minimum of 17%. Alternatively, we could do what we use mostly in the mortgage market here, which is when you go for a mortgage, let's say a $400,000 mortgage, and the closing cost is about, let's say, $15,000, $20,000. Many times the banker will say, should we just include that and lend $420,000 so that you can pay off the mortgage costs and then keep the $400,000 to yourself. So in this book, we only discuss this method to include flotation cost, okay? So we'll just do that. And then we won't discuss how to increase the weighted average cost of capital. And again, let's just do an example. That's the best way to do it. So assume a company plans to invest $500,000 in the new printing plant. It anticipates a cash flow of $73,150 forever. It plans to issue a combination of stock and debt, which means the debt to equity ratio is 1. If it is same amount of debt, 50 is my debt, 50 is my equity, then obviously my debt to equity is 1. But it means that 50% is debt and 50% is stock. We use the same numbers, cost of equity 20, cost of debt 10, tax rate is 34, but now we have a flotation cost. There's a 10% for issuing stock and 2% for issuing debt. Now, since this is 50 and 50, we can actually get one flotation cost. We do 0.50 times 20, 0.50 times 10, take away the taxes because this is deductible. I'm sorry, the interest rate is deductible. So we end up with a weighted average cost of 13.3%. I'm sorry, this doesn't include without including the flotation costs. So the cost of capital is 50% of it is stock, 50% of it is debt, take away the taxes of 13.35. Now, if you're doing a net present value analysis, remember, this is going forever. So anything that's cash flow is forever. Let me just draw it here, 500,000. So what we're saying is zero, negative 500,000 I dish out. And then I get 73,000, let me be clear, 73,150 every year forever. So we know how to find this. All you have to do is to find the present value here. All we have to do is to divide 73,150 by the interest rate, in which this case it's 13.3%. So it's 0.1333, and it turns out to be 550,000. So that means our net present value, this is equal to 550,000. These are positive. This is negative 500. So my net present value is $50,000. But we are saying, wait a minute, though, we did not include the flotation costs. And the way we want to increase is say, how much more should we borrow so that we can pay those costs to the investment bankers? So we go back here and find out what is the average flotation cost, because it's 50-50, it comes to be a rough similar idea. 0.50 times debt is only 2% flotation cost. 0.50, 10% is the cost for issuing stock. So the average cost is about 6%. So now we just say, all right, how much do I need to borrow so that I can pay off and be left with 500,000? So the way to do it is 500,000, 1 minus 0.06 equals 531,914.89. Why? Because if I took this up there, multiplied by 0.94, I'll be left with 500,000. So 31,944.89 is what I'll have to pay my brokerage, which is 6% at this point, or at least it'll be 6% of this number is 31,914. I'll be left with 500. So now let me do the analysis, same analysis, except 0 is going to be minus 531,914.89, and then I have 73,150, 73,150, all the way to infinity. And the present value of that we already calculated was $550,000. So if we subtract, we are still up by 18,085 to 11. So as a result, we'll still undertake the project. With flotation costs 2, our net present value here is still a positive number, 18,085. Okay, so I hope that's easy to do. This chapter is not that difficult. So it's basically finding the cost of capital, how much a company should use as its minimum cost to evaluate project is based on the amount of, at what rate it can borrow from the market, either in the form of bonds or in the form of stocks. Then you take a weighted average, and then we will continue, and you use that for your net present value. Now, we are not doing chapter 16, because we don't have the time, but chapter 16 answers the question of, should you be having 50% debt and 50% equity, or should you have 30% debt, 70% equity? So there's a way to determine that. Well, not exactly, but there's a couple of theories on it that discusses the relevance of this capital structure, but we won't go into it now. And hopefully you'll get it in another class, in the other finance class, when you get to that. Thank you all. So this will be considered chapter 14, part 2. Thanks.